Hi, this is Scott McLeod from Brown Financial Advisory. With the recent jobs report, I thought it might be a good time to talk about what's happening in the economy and the economic outlook for the rest of 2025. There are quite a few things that are happening in the economy and some things we've never seen before, so I thought it'd be nice for us to talk this through. So let's get started. First thing is we have some disclosures, and then we're basically going to look at three different topics. The first one is the economy right now is weaker, and there are some really significant signs that the weakening is accelerating as we get further into the year. And what does that really mean in terms of what happens to the economy, what happens to your portfolio? The second thing is, where are we in the investment cycle? In other words, we're seeing GDP growth, but the market is expensive. And how does that play into the portfolio allocation? And then the third thing is we're managing through volatility. And when you manage through volatility, there are some very specific things that you need to do to help the portfolio succeed over time. So we're going to touch on each one of these three. The first is the economy is weakening. And here are some statistics that suggest that we're seeing an economy that is beginning to slow down. The first one is the ISM Services Purchasing Managers Index, and it's starting to weaken. As you can see, right now the index reported in July was 50.1. Now, one thing about this particular index is that services comprise 89% of the U.S. economy, and therefore it's a very important indicator of what's happening in the U.S. economy and the outlook for the future, at least in the near term. And you can see since about July, the middle of last year, we've been on a steady decline. As the result, we're starting to see some negativity in that services index. 50.1 suggests still market expansion. But once that number drops below 50, now we're concerned that it's a contraction and things are going in reverse. You can see we're very, very close to that number, and dating all the way back to January 08, we've only been at this level a couple of times. So it sort of suggests that the economy really is starting to slow, even in the services index, which is such a large part of our economy. It's an important indicator to watch for the future. The next thing is retail sales. Now, this is an interesting one in that you can see from the arrow that we're in a decline in retail sales. The good part is that sales have maintained the level above what we saw even as recently as last fall, August, September of 2024. However, there is a consistent pattern now where the decline seems to be occurring month over month, with the most recent reading here in July. Retail sales are also an important indicator, and especially for those groups that are maybe in the lower middle class section, we're starting to see those things slow in a significant way. So that's showing up in the retail sales numbers. Finally, as you heard today, new job formation is very weak. We've seen some of the lowest numbers that we've seen in recent history in new job formation. Today it was reported that for the month of August, only 22,000 jobs were created, and in June it was revised to a negative 13,000 jobs. So we're seeing a significant decline, and this is a steep decline in job formation. What we really don't want to see are month over month, quarter over quarter negative numbers in job formation, meaning that more jobs are going away, because that's going to result in higher unemployment. Ultimately, this is a sign that companies are starting to buckle down and they're starting to prepare for slower times. They're looking out ahead and saying there are uncertainties that we can't predict, and therefore we're going to buckle down, not create new jobs, keep the jobs we have maybe, but not create new jobs. And so we're starting to see this significant decline. One thing important on this graph is you can see we saw something below this within that COVID time frame, but we go all the way back to 2009 before we saw this level in the past. So this is a time where we have to really pay attention to this lack of job formation, because it is a material forward indicator for what's happening in the economy. Now, the next thing I'll share with you is where are we in the cycle? So the U.S. is continuing to grow, and believe it or not, the outlook for GDP growth from most economists is still positive. When you look at this chart, you can see that even at the end of 2025, most economists are expecting modest growth in the GDP. That means our economy should continue to expand, which will mean that we'll continue to see job creation, we'll continue to see stability in the economy, and for the most part, you should have a stable base for the stock market. Unfortunately, the US stock market is very expensive right now. This is an example of a historical forward price to earnings ratio. Now, to be honest, the price to earnings ratio is not the best indicator of future performance of the market. But what it does tell us is how expensive the S&P 500 is relative to other periods in history. And you can see right now we're trading at more than 22 times earnings. And really there have only been a couple of times in history where we have been at this level. That should tell you that the outlook for future performance is muted, because once you start at an expensive stock price, it's very difficult to continue to grow because it's priced for perfection. And unfortunately, it's unlikely that the market's going to deliver perfection, and therefore we're going to see one of two things. Likely we'll see the market either come back a little bit, and I wouldn't be surprised if we saw that in the fall or early spring, or it just stalls out and waits for the earnings to catch up. A lot of that will depend on the sentiment. So if the sentiment begins to decline because the bad news starts to pile up, investors are likely to begin selling those things that are too expensive because frankly, they just can't meet the expectations. But this graph is interesting because it shares a little bit more information about the US stock market as a whole. So the last graph was the S&P 500, which is represented by this red line. The S&P 500 also contains the 7 or 8 largest companies in the S&P 500, which, as you know, are companies like Alphabet or Google and Amazon, Microsoft, Meta, Nvidia, etc. And those are giant companies, and they're also included in this mega cap 8. So you can see the mega cap 8 forward price to earnings ratio is close to 30, which is really expensive, but these are growth oriented funds and the idea, or companies, and the idea is that they can grow their way out of this. On the other hand, the S&P 500 as a whole, including those companies, is trading at 22 times earnings. So if you own the index, you own those companies, and that's still expensive. But once you get down into mid cap and small cap ranges, the mid-cap 400, for example, or the S&P 600, which are small and mid-cap stocks, you can see that the valuations are actually really quite fair. You can go all the way back to the year 2000 and map that out, and it's really close to the average. So while these stocks may not be inexpensive, they certainly do not reflect the expensive nature of the S&P 500, and therefore we would consider that an investment opportunity. Now, some of the growth is limited depending on the parts of the market, etc., and profitability. But in general, you've got another part of the market that still has some growth potential when the growth potential for the S&P 500 as a whole may be a little bit muted. It's an opportunity in the portfolio and is part of our diversification strategy. Now, finally, I'll share with you how we're managing through this volatility. There is very important to realize that volatility is a normal part of investing in the stock market. The market goes up and down all the time. Thankfully, it goes up more than it goes down over time. But what does that mean for you and your portfolio? So the cycles are normal, and that's what this graph demonstrates. There's a lot of information here. The black line represents the S&P 500 and how it has grown over time. The red lines below represent volatility, and you can see the spikes in volatility in 2020, and this only dates back to 14, but you can imagine what it looked like during the Great Recession. It was horrible. Or you go back to the dot-com bust, also horrible. But even most recently, we see this volatility that occurred earlier this year where we saw it jump to 9.5%. This was during the decline earlier this year, was almost a 20% decline top to bottom, but you can also see that the market bounced right back out of that decline. The most important thing to realize is that this is like a bouncing ball. It goes bouncing upstairs where it's bouncing up and down, and you see troughs and peaks all along the way. One example is in 2022 when it dropped 24%, so we see that But the takeaway is that the line continues on a positive trend given enough time. And it's not usually that much time after the decline that the market fully recovers or your portfolio can fully recover. But the thing to remember are there are things to do during periods of volatility. This graph demonstrates that beautifully. This is a simple graph of the Vanguard 60/40 portfolio. It's 60% stocks, 40% bonds, and I like to call this the oldie but goodie. This is a graph that we put together a few years ago, and it dates from September of 1994 all the way up through September of 2021. And basically what we saw is that the basic 60/40 portfolio, these are 5-year rolling returns, the basic 60/40 portfolio has 273 5-year rolling periods across this 1994 to 2021. Of the 273 periods, 270 of them were positive, which is a basic takeaway that over this 28-year period, this very simple 60/40 allocation is positive almost 99% of the time in a 5-year time frame. So what does that mean? That means that if we see volatility because the market starts to react, the sentiment turns negative or the news turns negative, there is no need to panic because we're not managing month to month, week to week, even year to year, because frankly, the market is far more reliable in longer time frames. So this graph is a great thing to remember that in a typical 60/40 allocation, it's positive 99% of the time, at least in this particular example, over that 28-year period. And it is generally that positive in most 5-year time frames. So it gives you the reassurance that you can stick with it and it'll do the right thing. So ultimately, we'll rebalance, we'll consider Roth conversions, we'll consider whether or not you want to be more aggressive in the portfolio, we'll find opportunities for buying the cheap stuff, et cetera, et cetera, et cetera, during those periods of volatility. But most of all, you remember that the market comes back, it recovers quickly, and generally in a 5-year time frame, it's positive. So in other words, no need to worry. So I wanted to thank you very much for the opportunity to spend time with you. I hope that this has been helpful. Please let me know if you have any questions, and I look forward to talking with you soon.